but I wanted you to know there's two different types of stock out there. Okay, thus ends our detour on financing the corporation. The next issue we need to talk about is taxation, and I'm going to make this really simple for you. And the reason why I'm going to make it really simple is because I don't know a lot about corporate taxation. It's not an area I'm particularly strong. It's complicated. It's complex. In the past, when I've taught this class, I've had kids in the, I shouldn't say kids, students in the class who have some either class work experience or real world work experience in accounting and taxation, and they guaranteed know more about corporate tax than I do. To me, it's phenomenally boring and incredibly complex, and I could just never quite grip it. However, here's what I do want you to know about it. First of all, it's a completely separate tax system. We talked about sole proprietors and partnerships, how they're taxed pretty much the same way any of us are taxed when we file our income tax returns, which you should be doing pretty shortly here. It is tax season after all. So a sole proprietor is going to claim the profits from his sole proprietorship on his personal income tax. Same thing with a partner in a partnership. The owners of the corporation, the shareholders, will not claim the profits of a corporation on their personal income tax. This is a good thing if you're a shareholder, because you don't want some corporation's profits stuck to your name for investment, for taxation purposes, for income, for calculating your income. You may be taxed on something called capital gains. And the way that works is if you earn a profit from an investment, like buying stock in a company, those profits that you've earned on that investment will be taxed as a capital gain. So there's a lot of debate about that right now, so I don't want to get into it. But you don't get off scot-free as a shareholder, free of all taxes, but you're not taxed based on the corporation's profit. The corporation itself is taxed based on its profit. So it's a whole separate tax system, which means that the corporation itself has to file, has to get its own forms, a completely different set of forms, file a completely different set of information with the government, and make sure those are all done properly under a whole completely different set of rules than what we operate for our income tax stuff. And of course, there's a completely different schedule of rates that they're taxed under. It's not done based on the brackets for income taxes. It's based on something else completely. So that's really all I care about, you know, that it's completely separate, it's completely different, the rules are different, the rates that they're taxed are completely different, and usually it's standard, you know. So anyway, we won't spend too much time getting relevant deep into that. Let's just move on, because there's more fun things to talk about, like liability. Alright? So here's how we're going to tackle liability in corporations. In the past, with these other business forms we've talked about, we've always focused on the business owner and the business owner's liability. We're going to do that here too, but we're also going to talk about liability for directors and officers, because, well, we'll get to that. But there's some interesting issues concerning liability because the corporation is a separate entity. Alright, so first let's talk about shareholders. Alright, shareholders enjoy what's called limited liability, and we've talked about this, we've probably talked about this by now a little bit already, but here's generally what that means. We know that personal liability means that you are personally liable for the debts and judgments against the company. So if you're a sole proprietor and the sole proprietorship owes a debt, you as the sole proprietor are going to be personally responsible for it, so your personal assets are at risk.
Corporations' shareholders have limited liability, which means their personal assets are not at risk. This is a good thing, because if somebody sues Coca-Cola and gets a judgment for $1 million, and you happen to be a shareholder because you have an E-Trade account and you went on your E-Trade account and bought 10 shares of Coca-Cola Incorporated, you're not going to get a knock on the door from some debt collector guy, holding a judgment in his hand saying, hey, fork over, your bank account because my client has a judgment against Coca-Cola and you're one of the owners of Coca-Cola. It doesn't work that way. Limited liability protects the shareholders from that scenario exactly. However, shareholders, just like anybody else who has limited liability, there is risk involved. You risk losing your capital investment. So in other words, when you buy a share of stock in a company and you pay, let's say, $100, you're risking that $100. You may lose that $100 if somebody gets a judgment against that company and the company goes bankrupt or completely folds up. You will lose that $100. Right? So you don't have complete protection, but you're only at risk up to the amount of your capital investment. You can't lose more than that as a shareholder. That's limited liability, right? There is one exception to this. One exception where shareholders lose their limited liability, and that's called piercing the corporate veil, right? But we will talk more about this when we discuss the Poland versus Kinney Shoe case, which, by the way, is one of my favorites. I love this case, and I can't wait to talk about it when we come back next week. Okay, so now we've covered shareholders. We know shareholders have limited liability in the corporation. Let's talk about the liability that directors and officers have. This is a little weird, right? Because essentially what we're talking about is people who work for the corporation. If you work for a partnership or a limited partnership, if you're a manager, for example, and the company does something wrong and gets sued or owes a debt to somebody, no one's ever going to go to the employees and make them pay because they are not the owners of the company. Directors and officers, kind of the same thing. You don't think about them being responsible for the debts of the corporation, and they're not. They're not liable to third parties and creditors. So when the corporation they work for gets sued or owes a debt on a loan that can't be paid, no one's ever going to come to the directors and officers and make them pay out of pocket. If they happen to be shareholders also, which again is very common because a lot of times shareholders elect their own to be directors, and a lot of times officers are hired and they're given some kind of stock option compensation plan. So a lot of times directors and officers are also shareholders, in which case they risk losing their capital contributions or whatever value is in their stock, but they don't have personal liability. All right, so they're not going to be personally responsible to third parties or creditors. So then what are we talking about? What kind of liability do they have? All right, they do have some liability. They can be liable to the corporation itself for breach of a duty. And we're back to talking about duties again. And we've talked about duties as it relates to contracts, negligence. We've talked about it in so many different contexts, and here we are again, all right? So let's talk about what duties are owed by directors and officers to their corporations. There are two of them. The first is called a duty of loyalty, right? And generally speaking, what that means is that a director or an officer must always act in the best interest of the corporation. Generally, they can't go putting themselves ahead of the corporation. All right, now, there's a couple ways that this can come up. There's a couple ways that this becomes a problem. All right, the first one is called the corporate opportunities doctrine. Generally speaking, here's what this means. director or an officer is sitting in their office and contacts them and says, hey, I know I'm contacting you because you're a part of this corporation and I wanted to present you with an opportunity. I have a piece of real estate for sale that's on the beach in Florida, and I know your company doesn't normally buy property. You make, soda, but this is a great piece of property and it's going to be profitable, and I'm looking for a buyer, and I thought I would pass the opportunity to you. So the director or the officer sits there in their office and they look around and go, well, you're right, the company doesn't usually do that sort of thing, but I'll tell you what, I personally would love to own that property. It sounds like a great deal. It sounds like it could be really profitable. So why don't I just buy it and we'll call it good, right? That's a violation of the duty of loyalty. What that director or officer has done is taken an opportunity that was supposed to have been presented to the corporation and taken advantage of it themselves personally. That's not acting in the best interest of the corporation. That's not putting the corporation ahead of themselves. So it's not being loyal to the corporation. Just so you know, there's a way around this. If the director or the officer goes to the board of directors and says, I've been presented with this opportunity. I am informing the corporation that here it is. If you wanted to buy this piece of property, this is what I was told about it. Are you interested? And then the corporation has the opportunity to go through whatever normal chain of command and decision-making process they go through, and they decide, no, we don't buy property. We're not a real estate company. We make soda. Why should we want to buy a piece of property in Florida? And then the director or the officer says, fine. Having presented that opportunity to you and you having rejected it, I would like personally to use my own personal money to take advantage of this opportunity that was presented to the corporation. Do I have your permission and approval? And if the corporation says, yeah, we're not interested in doing it, go ahead, knock yourself out. Hope you make $1 million off of it. Then you avoid the violation of a duty of loyalty. So you see how that works. By presenting the opportunity to the corporation and letting them make up their own mind first, and then disclosing that you want to take advantage of the opportunity since the corporation will not, you've covered your behind every way possible as far as loyalty is concerned. All right, so that's corporate opportunities. That's one of the ways that this sort of thing comes up, and one of the ways that directors and officers have gotten themselves into trouble, violating a duty owed to the corporation. Another way that this comes up is in self-dealing and competing. Self-dealing occurs when the director or officer puts themselves in a position to take some kind of improper stake in the business of the corporation. It's kind of rare and a little bit strange, but the best example of it I can give you is if a director or an officer is lending money to the corporation without full disclosure.